We are going to start this part 3 of the trading analytics project by making a quick introduction about some basic calculation that you will have to use almost every day in finance. These calculations are the daily returns. If you are getting used to it, that will be just a quick refresh for you. Okay, as I explained at the end of the part 2, this graph is not relevant for multiple reasons. The first one, and the major one, is because the scale is different between the different shares. For instance, if we look at Snapchat share price, we can notice that the price of Snapchat dropped from 20 USD to 6 USD, which means that the share price lost around 66% of its value. However, that's very hard to notice it because the main share which is more obvious in terms, at least visually, is Netflix. When you look at it, that looks like Netflix lost more value than Snapchat during this period. That's why that's important to index all your different shares that you are going to compare visually on the same scale. Indeed, we have USD, but we are not comparing the same share price, the same share buying price. For instance, as I explained just before in the solution part, let's say you buy a stock which was 10 USD in 2015, and 5 years later, the stock price rise by 6 USD. By another hand, there is this other stock which was worth 100 USD, and the share price 5 years later is 130 USD. For some people, or just overall, that's easy to think, oh wow, the increase of the share price must be more massive than this one. Indeed, in terms of capitalization, we took 30 USD. But in terms of profit, this one it's much better, it's 2 times better. In this case, we gain 60%, and in this case, we gain 30% of return on the initial investment. That's why in the first part I'm going to query you to include the new calculated field inside your data frame, which is a percentage daily return. In order to calculate the percentage daily returns, the return will be equal to the price. As you can see here, the price divided by the price minus 1 minus 1. For instance, if at the end of the day one, the price of this first shares was evaluated at 10 USD, and at the end of the day 2, the price went from 10 USD to 10.03 USD. What you are going to do, you are going to divide 10 by 10.03 minus 1, which means that here you will have 10.03 divided by 10, that's my mistakes, which means here you will have 1.03 minus 1, which means plus 0.03, which means between day 1 and day 2 you gained 3%. On Python, in order to do so, you have two options. The first one will be to use the PCT change function, which means you will have to do 1 plus your closing price column dot pct change 1. 1 will determine the number of market days that you want to include. For instance, if you use 2, that you will not have your daily returns, you will have your B daily returns, which means you will have your return after 2 days. You will have here, instead of having P divided by P minus 1, you will have P divided by P minus 2. You will have 2 days gap. Second solution will be by, like in the holidays, which means making your calculation by yourself, which means DF closing price divided by DF closing price dot shift and the number of days minus 1. Both are good. In our example, we are going to use this first one in the correction for the solution part. However, you can use this one as well, that at your convenience. Once you calculate your daily return, what you will get, you will get a column for each day, the return that you have made. Let's say 1%, minus 2, plus 4%, minus 1.5, etc., etc. And the goal of calculating, you will have your daily return, and here the goal will be to calculate your cumulative daily return. For instance, let's say that will be snapshot, for instance. Okay, after day 1 you gain 1%, after minus 1, plus 4, plus 3, plus 1.5, in order to see if at the end of the day you are profitable or you lost money. Thanks to that, you will be able to plot your results by this way on a graph for the different share price, and you will be able to calculate and to find out what is the trend on the long term. Similarly, in order to do so, you can use a function already included in Python, which is called cumprod. I have to do 1 plus df pct daily return dot cumprod. That will be the pct daily return percentage daily return column dot 1 plus this percentage dot cumprod, and that will bring you your daily cumulative return. Okay, now that we are done with the theoretical explanation, we are going to start by the advanced task that you have to retrieve. For the advanced level task, you will have to create a loop. That will be a very challenging loop, but you will have to create a loop which will execute this calculation, which means this one and this one automatically. Which means you will have to set up a list with the different data frame, a list with different tickers. You will calculate the length of the list, but that doesn't matter right now. I gave you a quick frame, again, that will be at your convenience. If you have another a loop which is much better, but what is the goal behind? It's to automate the creation of the new calculated column that we will have to name returns and cumulative return. In order to check if your results are good, if you loop and that your loop brought the right result, you will have to get the data that we already have, which means high, low, open, close, volume, and adjunct close, plus the return and cumulative returns. The first one will have to be NA, and the last one you will have to need to have your cumulative return for the latest day, which means here, which was 26th of May. Once you have done that, the next step will consist of setting up your trace and plotting the cumulative return in 4 steps. Declare figure, add prices, x and y axis update, and show the graph. Similarly to what you have done in part 2, you will need to update the x and y axis, plus have the title of the different share price. The final output must be similar to this one. The second graph that I'm gonna ask you to trace will be the following one, which means a graph on which you will have the evolution of the share price for Snap and the volume on the same graph. I will ask you to visually, I believe that the volume traded, if you divide it by 20 million, you must have something which is nice, but if you want to divide it by 40 million, that will be fine as well. You will have the share price on the x-axis and the volume, which means, like, for instance, here we have 11.61, that will be, the volume traded will be 11.61 times 20 million. But what is the goal here is to be able to find out visually a correlation between the volume traded and what's happened on the market. As you can see here, for instance, on the 7th of February, we had the most important date for Snapchat in terms of volume traded, which correspond to the main high for Snapchat as well. And once you developed your graph, you will have to answer the following question: if you noticed any correlation between the volume and price. I'm talking, when I'm asking you this question, it's visually, if you can notice any correlation. And on top of that, that's going to be an extra task for the part 3, which is not mandatory, but that's good if you do it. It's to plot volatility, to make a volatility comparison between Netflix and Uber. Because as I explained here, we will have the different daily variation for the different shares, and more shares is volatile and more risky will be the investment. That's why you must take into consideration the volatility. I will explain it later when we are going to talk about Sharpe ratio. And what I'm asking you to do here is to plot and compare the volatility for Uber and Netflix, and to plot it into the same graph. As you can see here, Netflix looks to be more volatile than less volatile than Uber. If you see here, Uber looks to be much more scattered than Netflix. But you will have to develop it visually and have a graph which is gonna be similar to this one. Okay guys, good luck and see you in the next part once you are done with that.